Hi everyone, welcome to a brand new video where we'll be talking about the concept of value averaging. Now, this is a term that we've often heard a lot of times, we've often tried to implement this in our real lives and try and make sense of, let's say, whenever the markets are crashing, or let's say whenever the markets are going up, as to how does one really go about value averaging, right? Now, at this point of time, I actually want to take a pause and say that let's say, for example, you're not as active in terms of picking stocks and you just have a few sips running and you really don't bother a lot as to what should I do, right? In a base case scenario, what is the answer to that is what we'll be discussing in this video. And at the same time, how do we really use the principles behind value averaging? And when we talk about value averaging, is it just buying high, I'm sorry, is it just buying low and selling high, and when something's very overvalued you sell it, something comes down you buy it again? This is again, a large part of this is actually hindsight bias, and whether this really works out in the real life or not is something which people can only say looking back but not looking forward. So can we really put a framework to do this? And what are, let's say, a few principles which guide this concept, right? So let's try and address them today. So the first thing obviously is, markets go up and down. So just from the point of view of a construct, let's say you have a SIP running, right? So you would probably expect that the returns are something that you expect, but the issue is the returns are never linear. So while you may expect that my money grows at maybe a 13-14% rate, but that 13-14% growth rate is not going to come like this, but it's going to come like this, right? So let's say even if you do nothing with your SIPs, they just continue to run. Maybe if your incomes rise or if you're able to optimize on your expenses, you top up your SIPs from time to time. You do a 10% top up or a 15% top up, etc., based on what the comfort level is. One part is that. The other is, let's say, even if you do nothing, the whole volatility and the whole concept behind value averaging, or in the West it's called dollar cost averaging, is actually designed in such a way that whenever this volatility comes in the markets, the SIPs allow you to take advantage of this volatility, and it helps you in value averaging without doing anything, right? And we'll discuss this towards the end of this, but let's say, uh, let's come to the more active scenario. Can we really put a method to the madness? Can we really put certain principles that will allow us to value average as we move ahead in life, right? So the first principle which actually guides, right? So for the sake of the discussion, we are going to break it down into three basic assumptions, right? So the first assumption is you need to have a defined time horizon. Now, what do I mean by this? So let's say you've started a SIP saying that, okay, I need to be wealthy, and this SIP is going to fund, let's say, my son's college education, or this SIP is gonna fund my Maldives vacation, which is after 4 years. So you have something of a time horizon in mind that, okay, this is a SIP that I want to run for 4 months, or this is a SIP that I want to run for 4 years, or is this a SIP that I want to run for 20 years? So in a 4 year time frame, maybe the volatility that you want should be a little lower versus a 20-year time frame where you can absorb the kind of volatility that you're looking at, right? So it becomes very important in the very first step to understand what is the time horizon that we are looking at. And this could again be linked to your goals, or could just be simply a time frame. The second thing is, what is the target growth rate that we have in mind, right? So it could be, let's say, if you are trying to fund for your child's college education, which might kick in after 26 years, right? So maybe you've picked up a small cap fund with an expectation that, okay, this is gonna give me a target return of maybe 15 to 20% over a 25-year time frame. Whereas, let's say if you have a goal which is gonna happen 5 years later, maybe there the expectation for you to have a target growth rate could be 14% or 13% or 12%, because you know that I want this money in 4 years, but I don't want the kind of volatility which can be there, let's say, in a small cap fund or in a small cap stock. So maybe I've stick to a simple index fund or a large cap mutual fund, etc. So that's point number two. And point number three is, you need to have defined time frames for review. So For example, just as a simple exercise, even if you don't want to overcomplicate this whole discussion, a very simple thing that you can do is that every year on 31st March, when you're filing for your taxes, or when your chartered accountant is suddenly not very available for you, because he's also stumped with a lot of work. But uh, while filing your taxes, while doing your taxes, you can actually take a hard look at your entire portfolio and say that, okay, this was my expectation. I expected this fund to deliver 13%. It ended up delivering 8%, or it ended up delivering 0%. That's also a possible scenario. So what this will allow you is to see that at what end of the curve you are, right? And accordingly, do you need to add more money? Do you need to go a little aggressive? Or there could also be a opposite scenario. So right in the year after COVID, right, maybe your expectation was that I would be making about 13%, but let's say you ended up making 40%, right? So there was almost a alpha of 3x. Or let's make the example a little simpler. So let's say your expectation was a 13% return, but you were actually uh, ending up making close to 16% or 17%. So at that point of time, you can take that 4% and try and reallocate it maybe to another SIP, or maybe just move it to a debt fund, or maybe just keep it in your bank. So that gives you some leeway, so that whenever you see some black swan events happen, right? So let's say in the last week we've seen Silicon Valley Bank collapse, or we've seen, let's say in the Indian context as well, the Hindenburg report coming, and suddenly uh, you know uh, putting Adani stocks in a spiral, which in turn has also put Nifty in a spiral, right? Albeit other conditions as well. So at that point of time, if you don't have cash, how are you going to deploy money, right? It's very easy to say buy the dip and keep buying, but what people always tend to forget, that capital is a constraint. People don't have unlimited capital, and they just can't keep putting money whenever the markets fall, right? That's not what we live for. But doing this exercise will help you, or will ensure that you have this money for a rainy day, especially to deploy again into the markets, right? So the three assumptions, to sort of quickly sum it up: firstly, you need to have a defined time horizon. It could be a 5 year, 10 year, 4 year, 3 year period. Then you need to have a target return in mind. That will give you some perspective on how to approach value averaging. Finally, you put time frames, which allows you to review your investments from time to time, right? uh, in conclusion, I mean, you could probably choose to ignore whatever I just said and just do nothing. The whole concept of market volatility and SIP is designed in such a way, or you can say it's a match made in heaven, right? So if you look at the graph in front of you, as I said, you are expecting the return to be 13% every year, but markets are so volatile that returns are never linear. So you won't make 13% every year, but yes, over a 5 year period, you might make a 13% CAGR year on year. On some years, you could be making 20%. On some years, you could be making 6%. So over time, the volatility comes down. So even if you do nothing, I mean, life still goes on, right? So let's say when markets went up 20%, maybe the amount of units you accumulated in your SIPs would be 20% lower. At the same time, when markets corrected 30%, the amount of units that you will actually end up accumulating is actually an extra 30%. So beyond a point of time, you will actually have a lot of quantity. So it's not that you put 1,000 rupees and you got 100 units, maybe you got 115 units. So even if markets remain flat, if let's say the amount is something which is of a constant, you will actually end up accumulating more units of a particular mutual fund, which by the time, let's say, you need to reach your exit goal, which is at a predefined time frame or a predefined target rate, that gets achieved automatically, right? So that, ladies and gentlemen, is what the concept of value averaging is. Let me know if you were able to get something insightful out of this, or is there something that I really missed? I'll be happy to continue the conversation in the comment section below.